Good morning, ladies and gentlemen. Today is the 29th of October, Saturday morning, bright and early. Actually, before the sun comes up out here in California. We're going to start off by going over my general market consensus and the custom indicators and get you prepared for next week. What a great rally last week. I mean, nobody really expected this except for possibly me, off of these deep, deep lows, this extreme low setup off of the longer term support channel from 2010 through 2012 and 13. We've seen this fantastic recovery. In fact, let's check it out. A fantastic recovery from here to here. We have seen an upside price swing of about, real quickly here, almost 12% in the past 2 weeks. What a big, solid move, right? Well, it's following along with my expectations here. We're probably going to end up in the 41.25 to 41.50 area for the S&P. This is my TT Charger and Auto Trend Master down here, indicators or systems. And what I want to point out to you is that we're still in an overall weekly bearish trend. We have resistance up here with a support channel way up here. We are in moderately weakening bearish trending here on the Auto Trend Master. We do need to get back above these previous highs, as I mentioned to you earlier. This level, 43.35 roughly, and 41.80 roughly on the S&P in order to see some more upward movement. Very highly suggests that we're going to move back into this area, right below this resistance after the elections or near the elections into the end of the month, and then possibly rotate a bit higher into the end of the year, maybe up into this 4,400, 4,500 area on the SPY. It looks like the U.S. markets are attempting to form a bottom, and earnings are coming in moderately strong, actually. Yeah, tech missed a bit, but when you come right down to it, ignoring Meta and a few others, Google came in strong, Amazon came in strong, and it's so funny to watch these numbers come out because, yes, there is underlying weakness. The second quarter and third quarter were much weaker than everyone expected. But, these numbers are still coming out. They're still making billions of dollars. What was it? Amazon or Google was off 0.5% in total revenues from expectations. Microsoft still came in relatively strong. Other companies coming in very, very strong. You have to understand that, a company like Google might make $27 billion a quarter. And so this quarter they came in at 26.3 billion. They're off by 700 million. Okay, well, they're still making, $100 billion a year, and net revenues are going to be close to $45-50 billion a year net. So what, they're off 0.5%. This has been one of the toughest times with raising rates, decreasing economy, global turmoil, war, and everybody's freaked out about 0.5%. I don't see it. I see the U.S. markets roiling around, moving into some sort of fourth quarter rally phase, moving into Q1, Q2, 2023 semi-rally phase, and possibly moving up, as I've been telling you, into a wave 5 rally, which, let's take a look at this long term here. This wave 5 rally that I was talking to you about last week looked somewhat like this blue line here, coming up and attempt to move to highs or potentially up to highs here. So understand that if we move up into this area, into this 4,500 area, that would be sufficient in my mind before the end of the year to see it roll over, maybe attempt nominal new highs up here, then roll back down a little bit, reestablish support, and then move into a Q2, Q3 rally phase to attempt to move much, much higher. So let's take a look here at the NQ. And again, we're looking at the same thing, same type of setup. We're looking for the wave 5 rally to set up. The TT Charger is telling us that we are in a bearish weekly trend. Resistance is here at 13,925 roughly. We do need to see the NASDAQ move above 13,000 here and 13,925. It's the previous peak area here. We've seen a nice solid basing and bottoming formation off of this extended support channel down over here. And what I want you to be aware of is, again, we could see some this may be an inappropriate line. Let me get rid of this, try to draw something that's more realistic. So here we have our big sell-off, our 5-wave, and I'm going to show you this in a new chart here. What we would be looking at is potentially something coming up into this area, rolling around a little bit, maybe up into this area, rolling around a little bit, and then up further. Now, the NASDAQ has some real potential here to move quite a bit higher. But in reality, ladies and gentlemen, I think because we've reached kind of a tech peak, we try to redraw that a little more efficiently, I think we're going to probably see something like this, down into here, up into here, down into here, and then some sort of nominal new high back over here before it finally starts to roll sideways. And that's because technology is still going to produce. It's still going to be an earnings benefit, but higher interest rates are going to put pressure on technology companies. We need to move solidly into some sort of a renewed innovation phase where we're going to be able to see technology really start to skyrocket and understand that we're in a wave 5 setup here. So wave 5, if we take a look at this, assuming wave 5 is about half or 2/3 of wave 3, which this would be wave 3 here. So let me grab that. This is approximately half, ladies and gentlemen. And what I'm going to do here is just drag it over here and show you that we're basically looking at a high on the NASDAQ at around, change the color, change the width, a high of around 19,550. That would be my estimate for a NASDAQ peak. Whether it hits at this timeline, which is September 2023, don't know. It will likely be end of next year or the following year. And then what we would have at that point, ladies and gentlemen, is we would have the end of wave 5 potentially, or this could be wave 1 of wave 3. So theoretically, if the NASDAQ were to stall at this point, then we would see some sort of a pullback, possibly down into this area again, see this big oblique here, this purple oblique, then find some support, start a wave 3, and then eventually come back and then start a wave 5. And that could happen. It could move up in waves. But ideally, wave 5 cannot be larger than wave 3. So understand that, well, I mean, technically it could. Wave 3 cannot be the shortest wave, so understand that's fine because wave 1 is essentially the shortest wave in price form. But ultimately, a wave 5 cycle, as I mentioned earlier, would put us somewhere over here. So 1, 2, 3, maybe somewhere right in here. That would put us at 24,300 on the NASDAQ. So we're looking right now for the markets to try to hold up this support. Let's go take a look at some of these custom index charts. First thing we're going to look at is the U.S. custom index weekly to global index. You see how the U.S. market has really started to strengthen here, whereas the global markets are extremely weak. This is going to continue to play out probably through the next 5 to 10 months, maybe longer, as the excesses in the global market continue to wind down. I drew this line here for the 2017 base. This is where everything originates here, 2017, beginning of 2017. You can see the U.S. markets are up 54% since 2017, whereas the global markets are minus 1.37. The strength of the U.S. dollar is going to continue to attract investment into U.S. assets, into the U.S. economy, and into U.S.-based assets. Now, there will be an unwinding in the U.S., so understand that housing, the excesses in the U.S. are going to unwind as long as the Fed continues to push rates higher and try to unwind inflation. We will see this continue. We may see some stagnation, but I do believe we're going to see a Christmas rally back up into this area, another 15-20% higher. But we could see some stagnation over the next 8 to 12 months, meaning it may not be the same as a big recovery rally here or the post-2017 rally here. We could see it just move up 15, 18, 20%, stall a bit, move sideways through the end of the year before moving into a bigger trend in maybe February, March, April of next year. But the U.S. market is moving up dramatically stronger than the global markets, and I want you to pay attention. This unwinding phase of the global markets has been continuing for over a year now, and that's what people don't understand. This is not a U.S. crisis. This is not a U.S. event like the global financial crisis or the 9/11 terror attacks. This is a world event. This is everybody outside of the U.S. having excess debt, excess credit, not prepared for what's coming next, slower economy, speculative bubble peaks. This is really the unwinding of those speculative bubble peaks. And we may see some sort of a deep washout pattern in the global markets before they try to find a bottom. Okay, next we are going to go to something that's brand new, which is right here, the capital flow index. This is something that I created to try to help you understand what's going on in the markets. We have the capital flow index here daily. We have the SPY here daily. You can see generally that the capital flow index starts to peak and or bottom before the actual market bottom. So we start to get some real basing back over here. You can see how it reacted. Here's an upward movement in the SPY. Here's downward movement in the cash flow index. We reached our bottom right here. This was our opportunity to really make some money in this upside. So here we have this upside momentum. We're starting to run into some resistance. We may see some sideways trending, might see some rotation going into the election year or the election this year. But you can see the SPY is moderately strong. The cash flow index is moderately strong, moving to the upside. We do have upward trending here. We need to see how this holds up. We are in an upward trend. Okay, so it's very solid that we understand that we're in an upward trend. Next, we're going to go to the leading market index. And I want you to see here that we've got this downward cycle. What's cool about this is that the custom leading capital index, which is, again, the measurement of capital flow in and out of the market, you can see that the capital flow index peaked out roughly, and this is weekly. Yeah, make sure this is weekly. Peaked out about 8 weeks before the COVID crisis, whereas the U.S. market stalled, rotated to new highs. The bottom in the actual market took place at the same time. This is where we started to see cash flow moving into the market. Notice that we had a big rally here with cash flow moving out of this phase, then stalled, then another big cash flow phase, then stalling into the election, then another big cash flow phase, and then peaked out right over here. Once we peaked out and started establishing this sideways trending, you can see that the markets continued to move a little bit higher. So this is an early warning indicator, a leading indicator that cash was pulling away from the market from June, July of 2021, all the way until the sell-off started in February 2022. So now understand that we've seen this perfect five wave, A, B, C, D, E, down to this bottom. And again, this is just a preliminary count. The reason I'm calling this a bottom is because it's down near this standard deviation channel, which I believe is going to become very critical in the future. We're starting to see upward movement. Starting to see upward movement over here. We need to see this capital index flow, this custom leading capital flow indicator continue to move higher, and we really need to see it move back up above this 2.0 level. This would indicate that my analysis is correct, that we're seeing cash move back into the U.S. market, and I believe that is going to happen, ladies and gentlemen. Christmas rallies coming. We're going to see moved into a potential wave 5 rally. We can't call it a wave 5 rally yet. It would have to get up above this wave 3 peak back up here, but we need to see this continue to hold up, and we need to see it continue to trend higher. If it were to get above this 2.0 level or this purple standard deviation channel, I would be very pleased that the wave 5 rally bottom is setting up, and we'll have to look for it. Remember, wave 5 cannot be confirmed. So hypothetically, it could move up to here, it could move up to here, it could move up to here, and fail and come back down, and this would then be an A, B, C downward trend, expecting lower trending. The only way we're going to know this is a wave 5 rally is if it continues to take out this peak, this peak, this peak, Eventually this peak and start to move to new highs. Okay, so next we are going to go to the U.S. stock market index. U.S. stock market index rallied last week very strongly off of this inflection point. Remember, I was talking to you about this Fibonacci price amplitude arc, this purple arc. I love these things, especially when they do what they're doing here. This resonates as a change in trend, a change in amplitude and frequency. You can see we've hooked higher. We've stalled right at this base. We've bottomed right down here off the COVID highs, which is perfect, pre-COVID highs, and now we're in a terror to the upside. We need to see how this reacts up around this 1080 level, maybe 1090 level, and this is going to be our real key. If it can break above this purple level here, then we may see some real strong upward trending. But we are right now, we are looking for what I'm calling a wave 5 start, and we're not quite there yet. We're in what may be a solid start to a rally, but we can't confirm it. We still have our very clear A, B, C, D, E bottom, and we're going to see what happens here. Just like I mentioned to you, it's got to get back above these nominal new highs, and ideally I'd like to see it back above this 1260, 1270 area to start confirming that we're really in an uptrend. In the meantime, expect a melt up, moving higher, and particularly as foreign capital rushes into U.S. assets, I believe we're going to see a melt up through the end of this year and into Q1, Q2 next year. Q2 may be mixed next year depending on how things work, but really Q4 of this year and Q1 of next year should be a fairly solid melt up in my opinion. All right, we don't need that. We need to come back over here, and we need to come to here. So the smart cash index is the global index. You can see it's flattened out and stalled. There's really no buying taking place in the global market. In fact, it's unwinding and stalling down near these COVID lows. I'm concerned that we may see a bit of a washout, deeper low type pattern, kind of a, let's call it a critical low event coming down, kind of like we had this week and last week in the U.S. markets where, unusual activity, deep low, kind of a bear trap, setting everybody up into a sell mode, and then watch it recover back up to this 125 level and start to move a bit higher or base. But we don't have any indication of any upward trending yet. The metals index, gold is still trying to bottom down here near these areas. Remember, these are pre-COVID high areas. I think these are going to become very, very important for gold and silver. We'll see how it plays out. There is news right now that silver bullion dealers are offering buyback plans, $10, $11, $12 over spot. So understand when they're trying to buy back your coins at 50, 60% over spot price, you need to understand that there's a shortage, and you need to hold on to your physical. It's very important you hold on to your physical assets, gold and silver. If they're willing to pay $10, $11, $12 over spot to buy it back from you right now, imagine what they're going to be selling it to you at a year or two from now. So get ready. Gold and silver are likely about to really skyrocket when suppliers, dealers are actually trying to buy it back at 50, 60% over spot right now. And that's really a kind of an initial price. It may end up being 100, 200% over spot. You might be seeing people trying to buy silver ounces at $45, $55, $60 an ounce here pretty soon. And that's going to put silver from where it is right now at $20, $18 an ounce. It's going to put silver through the roof. So be ready. This could be a very solid basing bottoming for metals right now. FANG's index, very mixed last week. Remember, I told you earlier that FANG's, the way I look at it, they're making a ton of money. No matter how you look at it, they're making a ton of money. They may have some directional challenges. They may have some scope and scale size issues to contend with through the end of the year, but they're still making a ton of money. And I do believe that the FANG's U.S. technology stocks are really looking very undervalued over here. We may get a bit of a blip lower. Next week we have a lot of earnings coming out. We might get a little bit of a blip lower, but this is probably a very solid base and bottom setting up right now. possibly an early stage base and bottom, but you can see this lower blue line here, anything down here in this below this lower green area right here is probably a pretty good early stage buy. Just consider, if you're going to get involved in tech at this point, start off with moderately small increments. Don't get married into this position right now. You got lots of time left to catch what may be a 40, 50, 60% rally back to the upside. Just understand that this is getting very bottomy, basey right now. And down here below this lower level, you call it 2 or 3% lower from where we're at right now, maybe 4 or 5% lower. That's probably a really good entry area for technology sector. Commodity gold index is stalled out last week. This is really kind of a sideways market when you think about it. Remember, these other charts are showing us that the markets are attempting to find some real growth. So understand here, we're starting to see cash move into the market. We're starting to see the SPY move higher. We're starting to see some real upward trending. For example, like right here, maybe the beginning of a wave 5 base or bottom, start of a new trend. But the reality is the commodity gold index is flattening out. The economy is flattening, but that doesn't mean that cash is not looking for opportunities. So pay attention here as to what happens. This is the commodity gold index. This is a measurement of commodity prices to gold and the dollar based on a VIX activity. VIX is flattening, the commodity is flattening, the markets are flattening. We're getting down here near this like upper baseline area, right in this area. And this is where things can change. If we were to get a rally, I would expect this chart to potentially move up to the 2.1, 2.2, 2.8 area up into here, and then maybe flatten back out next year. We're not going to see anything like this again unless we see the money printers kick back into gear with the Fed, which I don't think is going to happen anytime soon. I think they're going to keep their foot on the brakes, just not be stomping on it. We'll see how it plays out. Okay, the volume ratio, we had a little bit of accumulation last week, a little bit more activity and volume. This is good to see. We're going to see how this plays out going forward. This is basically a measurement of whether we're seeing up or down volume. We are seeing a little bit of accumulation or early stage recovery. The U.S. to custom valuation trends index is stalling out. This is a monthly chart. So for September, we've come back down, or sorry, for October, we've come back down. We've hit these lows, these purple line lows, and this right here, this 1.6182, 612 level, 1.6 it looks like. Long and short of it, we've hit this level. We found support. Let's see if this support holds and starts a new wave 5 rally to the upside. Custom gold index. This is October. We've already looked at this. You can see how we've rallied up in the U.S. market, and the global markets are flat. And again, this is going to continue. If what I think is going to happens is that trillions of dollars in assets are going to be moving into U.S. dollar-based assets and safety. That could include gold, silver, precious metals, Bitcoin, U.S. assets, and this could be a trickle phase. If we see this rally continue in the U.S. market and not really start off over here, you could see $2 or $3 or $4 trillion try to move into U.S.-based ETFs and assets, trying to catch this next phase upward, which could prompt a very big move here and continue to stagnate global markets. The custom technology ratio index broke downward. This really has wiped out, everything back to 2013 levels. We're very close to the highs, 2011, 12, 13. This is very bottomy to me. Remember, I was warning you that it looked like it may be bottoming back over here. Well, this is the earnings for Q3. It's broken downward. I would suggest that we're very close to a bottom here. And I've already told you, if you get involved in tech or decide to start buying tech, start off with very small increments. Don't load up on anything. It looks very bottomy. In my opinion, we've wiped out the last 8 or 9 years of asset valuations for technology based on this custom index back into this area. And if we do find a bottom over here, we're likely going to come right back up into these areas or maybe a little higher and try to roll around for a little bit before we find a base. Could just shoot back up into this 44, 45 area, But really, this is kind of a knee-jerk reaction off of earnings. In the U.S., it may be very close to kind of like a buy everything moment if my expectations are correct that we're going to see a wave 5 upward move. We're going to see capital moving into the markets. The Fed is going to pivot or at least weaken on raising rates. So we could be very close to a buy everything moment on the U.S. Stock exchange. But that does not mean buy everything globally. South America, Asia, Canada, Europe, they're very risky right now. They still have a lot of unwinding to go. But the safety of the U.S.-based assets and the earning capacity of the U.S. economy may push technology back up into this area, back up into 2017-18 price ranges, which would put it right up over here. And compared to where we're at right now, that would be a 25 to 35% rally from where we're at right now. Next, the commodity gold cycle index weakening strongly. This is fine. This is ideally, we are going to see this move way out here, 2027, 28, 29. But understand that this is what happens here. We get into this early basing phase like we had here. And remember, this is when we start to see real rallying phase. This is when the market started to base and rally coming out of it. Base and rally coming out of it. Base and rally into 2020. This is when gold rallied from what was it, $1,600 an ounce up to almost $2,100 an ounce. So we get this basing and rally phase coming out of this. Gold's next move is getting closer and closer. We're just not there yet. We haven't gotten out of the basing phase. This is very solid basing right now. And you can see we're rolling back to the upside a little bit. And this is where we started to see the move in 2019 in gold and back over here in 2015, 16, 17 in gold. So you have to understand that we're starting to get that real solid basing recovery phase, which means we could be a month or two away from seeing some upward trending in gold. The custom global asset index broke downward. This is a global measurement. We'll think of this as like a world stock market index. And what we're seeing here is the world market index is moving downward. It's broken out of this channel. It's in a downward cycle. We could see kind of a spike low, kind of like this, or maybe like this going lower. You can see back here in 2008-9, we had this deep, deep low. Remember, this was a U.S. crisis. And then we can see here 2006, we had a potential U.S. and global crisis. So understand that this could come down into this 0.87980 area, back down into this 2020 COVID area. This would be 2019 area. But understand that would be a great unwinding of the global asset bubble that's taken place. That would likely result in currency issues, potential default issues, central bank manipulation. So pay attention as we watch this going forward. Right now, we're seeing a very, a moderately deep breakout to the downside with a new low. This is indicating that the global markets are continuing to unwind. Okay, that's what it's telling you, is that there is no real strength in the global markets right now. It's looking for a bottom. Potentially, might be down here, might be down here, might be down here. Who knows? But it's looking for a bottom, and it's in a downward trend right now. Large cap index broke downward as well. This was again based on earnings, based on the rotation of price. This is the U.S. large cap index. So we're still holding up above the 2020 area. We need to see what happens next week. And if this rolls back around, this is a monthly chart. We need to see if this does hold up and start to move back to the upside in November. We could see it back up into this 1.25 area where I'm pointing, and that would indicate that this was a deep washout low, but we're in a deflationary cycle phase. So, we could see it wash out a bit further and continue to stay flat. And this could, large cap, understand, if large cap stays flat, what would that mean? That would mean that large cap would continue to produce, continue to have earnings, continue to deliver, but that capital focus may be on technology, may be on innovation, may be on other sectors that don't include large cap stocks. And that's why we need to pay attention here, in the sense that the actual focus of attention may be in various other sectors, not large cap. That's what this is telling us, is that there's not a lot of activity in trying to buy into large cap index right now. Consumer engagement index moved lower. This is acceptable in my opinion. As I mentioned to you, if we needed to see a recovery, we needed to see it come and move higher. But moving downward, as we've seen here, means that consumers are being cautious. We know that housing prices are unwinding, auto sales are unwinding, consumer spending generally is unwinding. Gas prices are finally coming down out here in California. We're no longer looking at, $6.50, $6.70, $7 a gallon. Now we're talking $5.20, $5.40. I know it sounds crazy, but out here in California, if we can get down to $4.40, $4.20 a gallon, we'd be jumping for joy, because we haven't seen that in more than a year. But long and short of it is consumers, I think, are repositioning for the end of the year, getting ready for the holiday. And depending on what goes on with COVID and the markets and the elections, we could see it actually, consumers stay moderately sideways. Maybe move up to this red line level here, showing a little bit of an increase in Q4 with holiday spending and travel, but then flatline back out into Q1 and really just be like, all right, we've had our holidays. Now we're going to hunker down, see what happens. So pay attention. Election years are always a little interesting. So for example, this is an election year back here, 2020, right in here. And of course, we had 2016 back over here, an election year. And of course, before that, we had 2012 back over here, an election year. So you have to understand that, and they happen every 2 years. So we have the primary presidential election, then we have the midterm elections. Then we have the primary election, which is back over here. Then we have the midterm election. And then we have the primary election back over here. Then we have the midterm election. Then we have the primary election over here. Then 2020. And now we're going to move into the midterm election back over here. So understand that we have these things going on perpetually. And now with the midterm election, I think we're going to see some stalling month over month. Maybe a move back up to this red line, and then some stalling before we break out and start to move higher. I do expect the U.S. markets to enter a rally phase before the global markets do. But a caveat to that, capital could quickly move into foreign markets if undervalued emerging markets and undervalued global markets suddenly become a focus for some sort of a recovery rally or reversion rally. Oops, so we ran out of that one. Let me see where we're at here. I think we need to come here and move through these. Custom index, FANGs index. Okay, here's the FANGs index. FANGs index has moved downward, as I mentioned to you. It's got a really good opportunity down near these lows. For some reason, I feel like I'm missing something. I think I'm on the wrong area here. Hold on. Global market we got, gold we got, that we got. Where is the volatility index? That's what I'm missing. Let me go find it. Hold on. So here. There we go. Valuations index we looked at, and now I look over here to the... there we go, the volatility index. That's the one I was missing. All right, the volatility index, just like I predicted, moved much higher. You can see here it's rallying higher. So now pay attention, ladies and gentlemen. So if you follow me long enough, you're going to understand here that we focus on, let's see here, this is not the one I want. So we'll leave it there. And we are going to come to here and go back and here. So the leading capital index is showing us the capital is flowing into the market. Think of that as early stage recovery, early stage Christmas rally, potential wave 5 rally. We'll see if it follows through. Okay. Secondarily, we have the volatility index is moving strongly to the upside. We found this base. Now it's got to come back up here to this 9.9 area, this pink line or this magenta line, and attempt to break through it. If we're going to see any type of a moderate recovery phase, we're going to have to at some point move into an upward sloping channel. We're in a downward sloping channel here. So we need to see this get above it and reestablish support and attempt to move higher. This move to the upside is very solidly bullish. It's starting to move back into bullish territory, exactly as I predicted, and it looks like we're seeing some early recovery phase setting up. Next, we have the consumer index. Consumers are pulling away from the economy. This is to be expected. Headed into an election, let's face it, the world follows the U.S. is what's going on. The U.S. economy is stronger than the world economy. The world wants to know what's going to happen with regards to the elections, what kind of turmoil that may come. The U.S. Markets are holding up, looking for a wave 5 bottom, a wave 4 bottom, starting a wave 5 rally. But it's likely going to slide through November and December with a moderate upside bias, and then maybe December, January, February, try to move a bit higher. So understand that we're looking at early stage recovery, essentially, right now. And then lastly, I wanted to point out let's go back over here. Let's go back here. Oops, gosh darn it, wrong direction. Right here, the U.S. market is rallying higher. We've seen a very solid base off of these pre-COVID highs. This is my custom U.S. stock market index. It's very important you understand that these custom indexes provide much greater detail than looking at the S&P or the NASDAQ or anything else. These give us a real feel for what's going on in the market and how market depth and activity is taking place. So consumers are stalling. Speculative traders are buying into this dip, into this Q3 earnings season, and expecting a moderate recovery. That's why you're seeing this upward movement. We need to, again, get above this purple line to see any real upward strength. So we only have about maybe 10 or 11 or 12% higher before we run into this purple line. But we're starting to see some real strength there. And if these lows hold, we could see a big solid breakout. What I would like to see in order to confirm that breakout, I would like to see consumer engagement recover back up into this purple line area. That would make me happy. And I would like to see the volatility index rally up above 10 or 11, attempt to get into this upper channel right over here, kind of like we did back over here, and then stall and then rally a bit higher. So we're getting into an early start of a recovery phase, what looks to be a recovery phase. We need to see how it plays out. Okay, so as we're moving forward, we're looking forward to opportunity here to see what happens. But remember, we may not see a real rally phase take place until, say, the 12th or the 13th of November. That's when it may actually start. Pay attention and be prepared, because we're going to have some great trends back over here in the TT scanner hot list and the live trades algorithms. So be prepared. There are going to be some great trade setups taking place, and there's going to be some good moves. We're already seeing great moves in the live trades and TT scanner hot list, but we're getting ready to see a pretty solid move that may end up being, hypothetically, from current lows up to these highs. We would be looking at, if I can get my mouse to cooperate, about an 85% rally, potentially, in the NASDAQ. If my analysis is correct, and that would likely end sometime in Q3, summertime to end of Q2, end of Q3 in 2023. If my analysis is correct, we're going to be looking at a pretty solid rally, a 65 to 85% rally in the NASDAQ off of this support level, starting the beginning of a wave 5, establishing a new nominal high, while the global markets continue to recoil and attempt to base. And that means there could be some opportunities in the global markets, but many of them are going to still be struggling to find some real support. All right, that's it for the custom indexes. We will go on to the TT scanner hot list and the momentum rotational modeling system. as well as the real estate index markets. Stay tuned, guys. We've got some really big opportunities coming up. Follow me and stay tuned for some real great trades.